Those with a home loan preparing to breathe a sigh of relief when the RBA finally stops its rates hike should perhaps think again this afternoon. A warning: the banks may continue to hike rates independent of any Reserve Bank decision. Finance expert Michelle Maynard from Carbon Group, good afternoon to you.
Afternoon, Mon.
Why would they do this?
So when the pandemic hit, the Reserve Bank lent just a small $188 billion to the banking industry to keep the economy going. And like with any loan, there comes a time when that needs to be repaid, and that's what's happening to the banks. Now, as you and I know, it's now more expensive to borrow than it was 2 years ago, and banks aren't immune to this. So as a result, they're going to have to go to the international market to borrow this money to repay the Reserve Bank. That means it's going to cost them more, and there's real concern that they're going to pass on those increased rates to their consumers, us mortgage holders, outside any official Reserve Bank rate increase, which we're expecting this year.
Some smaller non-bank lenders have already done this. Does this mean that the big banks could follow, as you said, maybe later this year?
Yeah, so the smaller banks don't have the luxury of having what we call a large deposit base. So when we hand over our hard-earned savings to the banks, they then go and on-lend that to other people. And we know we've been paid little to no interest over the past few years. So it's been a real buffer, especially for the big four banks, which hold the most of the deposits and savings in the country. Now, we know that they're going to have to start paying more interest on these savings accounts as the official rate goes up. They're not doing a great job of it. They're only paying on average about 1.5%, but that margin is getting smaller. So the big four banks aren't immune to this lending increase. The other pressure that the big four banks have is their investors. They like large profits, which means dividends for them. So while the smaller banks have had to move already, most of them have increased more than the Reserve Bank's official 3%. The larger banks haven't yet, but because of that investor pressure, they very well could increase over and above the Reserve Bank rate or outside of when the Reserve Bank does in the next 12 months.
So as always, Michelle, what's your advice?
So my advice is we need to really understand that banks aren't loyal to us. I hate to break it to everybody, but while you might be a long-term customer, they actually prefer new customers. If you have a look at what your interest rate is and look at what they're offering new customers, on average it's about 0.5% better. So pick up your phone, call your bank and try and renegotiate a better interest rate. If they're not going to help you, you need to become a new customer elsewhere where they're going to give you that great rate and possibly even some cash back for moving your business, because we know that can save you a couple $100 per month, which equates thousands of dollars per year. And I think that's the real concern for people. We were only expecting about 0.5% rate rise from the RBA, but now we have this threat of banks moving even more. Now's the best time to be getting the lowest interest rate you possibly can.
The RBA meets again on February 7. We will touch base with you again later. Thank you, Michelle.
Thanks, Mon.